Welcome back to QAV America, Tony. Episode 9, 009, license to talk about investing.
Well, we are.
It's not sexy. Like 007 is a license to kill, 009 is a license just to talk about investing. And we don't have a license to talk about it in America.
009, 009 was in one of the movies, wasn't he? I think from memory.
He was. Yeah. So, Tony, this week on QAV America, I mean, lots of chaos happening again over just in the US market. Everyone knows we don't need to talk about that again. I do have a pulled pork to do this week on a company called Jackson Financial. This is apparently Tito and the rest of the Jacksons. After Michael died, they turned themselves into a annuities business. Yeah.
Very smart of them.
Yeah. Can you feel it is the motto of the company. Dump, dump, da-dum, da-dum, dump, da-dum. Have you got anything else, though, before I get into Jackson's? Do you got anything else you want to talk about, Tony?
Well, we just talked off air quickly about it. I'll just mention, in case there are any overseas investors listening to this, that as part of the big, beautiful bridge bill that's going to the Senate, being passed by the lower house, there is a 5% tax on dividends and interest if you're an overseas investor and you come from a country that America doesn't like. And Australia is one of those.
Which is all of them pretty much at the moment, I think.
Yeah. And it rises by 5% for the next 4 years, every year for the next 4 years until it gets to 20%. So just be aware of that.
Tariff on dividends.
Apparently there are a lot of people upset about this in the US, in the institutional area, who are lobbying like crazy, lobbying their senators like crazy to have that bit taken out, but it may well get passed. And if you think about all the people who are foreign investors in the US, it's a large chunk of the US economy and market. Companies like Shell, who I used to work for, they're domiciled in The Hague and in the UK, and they're investing and operating in the US. So they'll be hurt by this if they pay a dividend back, for example, or receive dividends from investments. But then you think about all the big investment banks, HSBC, for example, and the other European ones, they'll be facing problems. And of course, the Australian super industry is trying to work out what to do because they have large investments in the US in the Mag 7. And I know they don't always pay dividends, but if they do get dividends, then they'll be taxed as well. So they're trying to work out what to do. So I'm merely raising it for people to be aware of it if they're investing in the US if the bill gets passed.
Yeah, I did see that talked about in the Financial Review, the Australian finance newspaper.
Mm-hmm.
Lots of gnashing of teeth and lots of different fronts with the big, beautiful bridge bill.
We should say to our US investors too, who may not have been along the journey with us, that we're referring to Kelly's heroes. When we talk about the big, beautiful bridge.
I figure that
go out and watch it.
Anyone who is cool knows what we're talking about there.
Well, you didn't know about that until we talked.
No, I wasn't cool. You made me cool.
I'll give you with Sorrel in the morning. Think that bridge will be there, and it'll be there. It's another beautiful bridge, and it's gonna be there.
There you go. R.I.P.
Yes.
Sutherland. So the Jacksons. Let me get into the Jacksons, Tony, and I have questions for you in this pulled pork because as much as I try to get my head around this and think it through.
I have questions for you as well.
Oh, you're pointing at something. Oh, okay. You have questions for me. I wonder if they're the same questions.
Sorry, just before we start on that, did you want to do a performance update quickly?
Oh, yeah, portfolio report. Thank you for reminding me. So let me talk about our US portfolio. I had a look at it this morning. Our US portfolio for the last 7 days was up around 4.65%. Versus the S&P 500, which was up 1.18%. For the last 11 months, which is the Australian financial year, our US portfolio is up about 28% versus the S&P up about 10%. And since inception, which is September 2023, our US portfolio is up 54% versus the S&P 500 up 35%. Now, that's a little bit over a year and a half. 35% is insane. I mean, our 54% is better, but even 35% for the S&P 500. Now, I know a lot of that, well, I don't know how much of that is MAGA 7, the MAGA 7 as I call them now. But a big chunk of it would be that. None of ours is MAGA 7, though. I want to point that out. It's all boring shipping and financial stocks, mostly.
Yeah, catalogue retailers.
By the way, I also wanted to mention to you, somebody on our YouTube channel questioned, last time we did a pulled pork on this a couple of weeks ago, I talked about Ford Motor Company.
Mm-hmm.
And somebody took issue with that on our YouTube channel and talked about the amount of debt that Ford is carrying and how he didn't think Ford was a good investment because of the amount of debt that they're carrying. And I said, well, look, if that's a concern to you, then you shouldn't invest in it. But said that from my perspective, I don't usually look at debt levels. We don't really look at debt to equity levels or anything like that. And I wanted to check this with you, but my thinking on debt for companies like that is we have a bunch of metrics that we do pay attention to where debt is part of it. They're financial health and those sorts of things. But at the end of the day, I figure that if it's a well-run business and has been well-run for some time and the management seem to know what they're doing, and a lot of our metrics score companies based on things like that, then they know what to do with debt. They're going to manage that debt well. Debt is a tool that can be used to grow a business if it's used strategically and tactically. They know how to use it wisely. And so I'm not really concerned about that as a major factor. I mean, it's one of the things that we're going to score a business on, but I don't get caught up in how much debt they're carrying as a business. What would you have to say about debt and Ford?
Yeah, well, I agree with everything you've said. It's part of our checklist in terms of the quality metrics that we use. I can't comment on the debt with Ford. I never looked at it by itself, but the comment I'll make is that for Ford to be on our buy list, it must be throwing off truckloads of cash, pardon the pun. And the biggest antidote to debt is cash. So as long as they're throwing off cash, they can usually service a lot of debt. So that would be my comment.
That would have been a great. Where were you 2 weeks ago?
Specifics of Ford.
That would have been a great name for that episode, Truckloads of Cash. Because it is coming out of the trucks division from memory, is where their cash is. Yeah. All right, let's talk about the Jacksons. Jackson Financial is a life insurance company in the United States. They're the 7th largest life insurance company ranked by total statutory assets. And for people like me who don't know what a statutory asset is, it's all the sort of the assets that they report under their accounting rules: bonds, stocks, real estate, cash, loans, recoverables, etc., etc. So they're pretty big. Market cap's around about $6 billion USD. Revenue is about $7.5 billion USD. They're a sizable business. They've been around a long time. But here's my first question before we get into the history and all that kind of stuff. The PropCAF, the price to operating cash flow for these guys, is really low. It's a 1.
Wow.
Which is pretty low in our metrics. Mm-hmm. But I know you and I have talked over the years about PropCAF and banks and finance companies, and I'm sure we've even talked about it on a US show, but they're not like, when you're looking at price to operating cash flow with a financial services company, because their cash flow is sort of choppy, quite often, and if they're doing refinancing or depending on what kind of business they're in, it can go up and down. And I know with insurance companies and premiums and policies and how they invest and how they borrow, it can be up and down. Is PropCAF something that we should be scoring it on, or how would you be thinking about PropCAF with a life insurance company?
Yeah, good question. I mean, don't think I have any life insurances in my portfolio. QBE, Australian stock, which operates a lot in America, is basically property and casualty, but their PropCAF is going to be like any other PropCAF. It's going to be the difference between the premiums that they generate. I guess in a life insurance case, it would be any underlying profit from the float, as Warren Buffett calls it, less the costs of providing that. So I think it's probably okay. I did have a question about that issue though myself, because I know that Stockopedia give it a low ranking for quality, and it often is the case with the financial services companies that the metrics are seen differently to industrials. So I don't know the company well enough to say any more than that, but I wouldn't have a problem using the PropCAF from a life insurance business, but I agree with your comments that they can be lumpy depending on, what their investments are and what they're paying out at the time.
Yeah, right. I mean, I asked GPT to sort of analyze it for me when I was talking to it about Jackson Financial, had a long conversation. And it said Jackson's cash flow from ops includes changes in reserves, big swings based on actuarial assumptions, movements in reinsurance balances, unrealized gains or losses on annuity liabilities, derivatives cash flows, and timing effects on premium flows, which means operating cash flow can be massively distorted by non-recurring or accounting-driven line items. It's not like a widget company selling 10,000 units a month. And then it talks about modified co-insurance, modco deals, and reinsurance costs. It says what matters when you're looking at an insurer is statutory surplus and free cash flow, capital generation after reserve changes, and RBC ratio maintenance. Jackson's is 585%, which is strong. But GAAP cash flow used in PropCAF doesn't tell you how much cash they can return to shareholders, so it's not a good standalone valuation metric. I thought, well, this is above my pay grade, so I'm not even going to try and pretend that I understand how all this works. And PropCAF is only one thing that we score these businesses on. I mean, we know that it's a pretty important one that we score them on traditionally. But going through this business, it scores well on quite a few metrics in terms of value for us. So I decided I would do a pull portfolio. We don't own it. I'll say that up front. It's not in any of our portfolios, but it is. I ran a new US buy list yesterday and it did turn up on it. So I'll talk about it anyway and people can make their own decisions. So the nature of their business, they specialize in retirement services, selling annuity products, variable, fixed, indexed, and fixed annuities. Founded in 1961 in Jackson, Michigan, which is 65 miles east of Kalamazoo, Tony, which I learned is a real place. I thought it was a wind instrument that you played with your mouth that made a twanging noise, but I guess that's something else. 75 miles west of Detroit. Kalamazoo was originally called Bronson after the founder of the town, Titus Bronson. And honestly, I'm not sure which is a cooler name, Kalamazoo or Bronson. I mean, they're both pretty cool names, but coming from Bronson, that's pretty badass. I live in Kalamazoo. It sounds more like a Looney Tunes character who comes from Kalamazoo. I don't know if I could take that seriously. Apparently the name Kalamazoo comes from a Potawatomi word that first found in a British report in 1772. So there you go. Native American name, Kalamazoo.
They weren't thinking about Bronson back then, probably.
No. But I think all cities should be talked about based on how far away they are from Kalamazoo. So I worked it out. Brisbane, where I live, is approximately 14,900 kilometres or 9,260 miles for our American listeners by air from Kalamazoo. So there you know, that's where I live, is 9,260 miles away from Kalamazoo. About half a planet away from Kalamazoo, roughly.
And you can't get a direct flight from Brisbane to Kalamazoo either, so it's probably a little bit longer than that, a bit further.
Not yet, but we're working on it. Jackson, the town of where this place was founded, this company was founded, it was named after Andrew Jackson, the seventh president of the United States, best known for being a racist and signing the Indian Removal Act of 1830, which has been described as ethnic cleansing, displacing tens of thousands of Native Americans from their ancestral homelands east of the Mississippi, and resulted in thousands of deaths from what has become known as the Trail of Tears. So there you go. Jackson, Bronson, and Kalamazoo. Jackson is also historically regarded as the birthplace of the Republican Party because a meeting was held there in 1854, during which political figures gathered to oppose the expansion of slavery. And that was the beginning of the Republican Party. More interesting things about Jackson, the town. It was a big early center for the car manufacturing business before it all moved to Detroit. And it was the center for corset manufacturing. Don't know if those two things were connected in any way. But our railways had a lot to do with the corset manufacturing business being based there, I learned, because you could ship corsets out from anywhere. And so somebody decided, yep, there was like 20 different corset manufacturers in Jackson at one stage. Anyway, none of this has anything to do with Jackson Financial, which, unfortunately, I'm sad to say, has got nothing to do with the Jackson 5 or the Jacksons or anything like that, which is, in my opinion, a sad omission. They should have done some sort of, brand sponsorship deal with the Jackson family. I Want You Back could be one of their campaign commercials. ABC of annuity business, easy as 1, 2, 3. Like, it just writes itself if they had merged with the Jackson 5. Just untold opportunities for marketing here.
Is that why you picked Jackson to talk about today? Did you think there was a link?
It is.
Yeah.
I did. I thought I was going to be talking about the Jacksons, and I was greatly disappointed. I'm going to reach out to Laura Prieskorn, who is the president and CEO, and suggest to her that I have this great idea of where she should take the company next. She's been with the company for 30 years, and you can't tell me she has at least once or twice thought about, should we do an alliance with the Jacksons? Would that make sense? Would that be a good idea?
And
if I was running her marketing.
If she makes a mistake, does she ever say, I blame it on the moonlight?
You can't blame it on the sunshine. You can't blame it on the moonlight, Tony. That's the rule number one of Jackson Financial. Got to blame it on the boogie every time. Jackson, the financial company, apparently, as I said, been around since 1961. They were an early adopter of what is known as the independent distribution model. They got rid of their agency sales force in 1970 and started selling their products through independent agents. By 1984, they'd grown to $1 billion in assets. And then in 1986, they got acquired by Prudential PLC out of the United Kingdom. And then by the early 2020s, a decision was made that the Prudential business, which was more focused on high growth, high margin insurance in Asia and Africa, didn't really fit well with a stodgy life insurance business out of the US. So they spun it out in 2021 and it listed on the New York Stock Exchange. So it's only been, publicly listed for the last 4 years. And activist investors and analysts had been pushing Prudential to do this for a long time. They said it was undervalued, misaligned with Prudential's other story. So they announced in January 2021 that they were going to demerge, and it floated in September 2021. And it's done okay. It IPO'd at $31 in September 2021, currently trading around $83. So if you got in on the float, that's not bad. Nearly 200% in 4 years. I'd take that. Not bad at all. In terms of the business, so this is another question I wanted to pick your brain on, because I tried to get my head around it this morning and couldn't. Mostly because I was tired from kung fu, and I just tried to get my brain to work, and not enough coffee, too much kung fu this morning. One of the risks ChatGPT was talking to me about with a business like this is fluctuating interest rates, and how that can impact a business that's involved in selling annuities. And I tried to drill down into it and couldn't get my head around it. So I understand that when somebody buys an annuity, they give the company money. You have a lump sum of money, you give it to a company, and they guarantee you they're going to pay you X amount of money every year for 10 years, 20 years, 30 years. The company takes that money and then they invest it in a bond or a range of securities, but primarily, I guess, a large percentage of it would go into bonds. And I understand that then, the company's trying to survive on the margin between what they're paying the customer and what they're able to make by investing it in a bond. But ChatGPT was telling me, interest rates go up and go down, and that can create risk. And I was like, but hold on a second. If you give me $100,000 and I say I'm going to pay you 3% on that, and then I can go invest it and get 4% on it, and I buy something that's locked in for 20 years. Isn't that secure? And it's like, yeah, it's not that easy. And if interest rates are low and somebody's getting 3%, they can get out of their annuity product. There'll be a penalty fee, but they might say, well, interest rates have gone up to 7% now. I want to get more so I can get out of that and go buy something that'll pay me a higher annuity, and it's worth paying the penalty because I'm going to make more money out of it. And then the company's a bit screwed because they're locked in and they can't get out as easy. You know a lot more about how these things work than me. Can you explain it to me in terms that I asked ChatGPT to dumb it down for me? It couldn't dumb it down enough. I said, really, I need to go to the original ChatGPT, Tony.
Oh, look, I did a little bit of research on this company before we recorded. So the first thing to say is it's a fairly complex business. So annuities are simple. Traditionally, as you say, you take someone's money for 20 or 30 years while they're working and then pay them a guaranteed income when they retire. And you back-to-back the payment with an asset that produces more. So whether that's a bond or the stock market or commercial property is in the mix, I guess. There's a company in Australia called Challenger Financial, which has done that for many years. And over time, I think they've worked out if they put more of their investments in commercial property, they can get a less volatile yield, which is enough to cover the annuity promises they make to people. I think from looking at this company, from what I can tell, it looks more like the superannuation system in Australia or superannuation fund in Australia. So there are some tax rules which are being used by investors or people who take out these products, which come into the mix. So it looks like the way it works, if people take advantage of the tax laws in the States, is you can contribute or it's a bit like a life insurance policy. You're making a payment over your working life, paying no tax on the profits of that payment, but then paying tax when you start to draw down in retirement. And looking at Jackson's various product offerings, and there are lots and lots and lots of annuities that they offer. There are some which are fixed, so you're guaranteed 4% a year or whatever for 20 years after a retirement date. And I think from memory, the tax law was after 59 and a half, you can start to draw down without penalty or start to pay. You can't, I think, make tax-free contributions after that. Anyway, that was for the 60 is about the magic number. Or you can put your money into some other funds that operate more like an index fund or more like a bond fund, or you can put money into a whole blend of funds and then use that to fund your retirement. But that's a variable type annuity. So yes, you're receiving a payment when you retire, but it is going to fluctuate depending on the underlying investments. So when I had a look at Jackson, it seems like it's much more like a fund manager. So there are dozens and dozens and dozens of funds operated by different managers on behalf of Jackson, some in conjunction with Jackson, and I guess they have them products on top, which can give you a blend of all those different things. So you kind of have like an index type fund across different assets as well. And I guess that they have people who advise you on what your blend should be, whether you should be getting more into gold or less into commercial property or whatever. So it's a bit of both. So I'm not sure whether interest rates they will have effects on all of those products. If it's purely a bond fund, as the interest rates go up, then it's easier for Jackson to pay out a fixed annuity if the rate is lower than the interest rate. I couldn't see too many of those style funds in what I saw. So it's more likely that as interest rates go up, it tends to have a negative correlation with companies who have to pay more for borrowings and therefore the stock market. And as interest rates go up, funds can often get diverted from buying shares to buying bonds because of the guaranteed high return in a bond as the interest rates are high versus the risky high return in the stock market. And the difference is called the risk premium. So it can have a negative effect on the fund. So it's that's a convoluted answer, but yes, rising interest rates will impact this company. Can be good, can be bad. So it's a mixed sort of result, I would think.
So it comes down to their ability to manage all of that and still make a profit.
Yeah, and look, I'm going to make a very glib sort of statement. The company's been around for a long time doing a good job. But again, when I looked across all their funds and various offerings, if you took the average of all of those, and I think people would tend to buy some of each fund rather than going all in on one, which is kind of the wise thing to do in the long term. You're getting a kind of index-like return. So then you question whether you should be just putting your money into an index fund or whether you should be going with these people. And that's a fairly superficial analysis because, they're going to guarantee a payment for a period of time. So that's got to be taken into the mix. And like I said, there are tax benefits in contributing to them over your working life. So that's got to be taken into the mix as to what you do. But yeah, if I looked at, my sort of high level assessment was maybe as a customer, you might consider putting money into an index fund rather than putting money into these kinds of products. But, they're big, they're successful. There's probably something more to it than that. But that was my overall sort of takeout from looking at this company.
Yeah. And we know that, people don't always make the most rational decision when it comes to investing.
Correct.
And particularly if they have a financial services provider talking to them who's getting paid a commission on selling them this product or that product.
We don't know if that's the case, but definitely. I guess the caveat for all of that is, if you're getting close to retirement, you don't want to be all in on an index fund if the market drops 30 or 40%. So there are some cases where it is much more suitable to be in this kind of product.
Yeah, it's more prudent. Well, that's, my level of understanding of their business. I did note in their Q1 2025 report, they noted they had a net income loss of $35 million or 48 cents per diluted share, partially driven by a loss on reinsured business. And I don't understand what that means, so I tried to get my head around how reinsurance works.
Mm-hmm.
Again, GPT tried to explain it to me, and I spent a long time trying to get my head around it. I understand the concept that the insurance company gets insurance on their insurance, and it's reinsurance. and they sort of offload some of the risk to another company, and they share the premiums and the claims. How that works out as a loss for them in the first quarter, I couldn't kind of get my head around that, so I gave up trying after a while. And again, it was one of those things that's way beyond my pay grade. But what GPT assured me is, it's a paper thing. It's an accounting thing. It's an on-paper thing. It doesn't really have any impact on the day-to-day of their business and how well or not that they're doing. It's just accounting stuff. Don't get caught up in it. So I didn't.
Yeah, look, this I guess goes back to your first question about operating cash flow. Look, there's a lot of assumptions and paper write-ups and write-downs that go into these decisions. So I agree, it's a very convoluted thing to try and work out the cash profit of an insurance company. It should be simple. It should just be, I've charged these premiums and I've made these payouts. But then, of course, the insurance company looks great in the early years when it's getting money in and not paying out until people reach a certain age when they're making claims. But, for companies that have been around for a long time, it should be in the wash. You should be at a stage where you're kind of at a steady state where you're getting premiums in, but you're also paying out because you've got customers who've been around for a long time. So it should be a simple thing, but it gets convoluted with the asset valuations and then the reinsurance risk that you're taking out, which should just be a cost of doing business, really. I'm getting less of the income, but I'm paying a premium to another insurance company to go jointly with me into this situation. So, but again, there are actuarials involved in, if I'm taking out this policy for 10 years and suddenly that area looks really bad, then I've got to write it down. So I understand that, but it gets convoluted.
One of the things I like about doing these pulled porks is it gives me an excuse or an opportunity to learn a little bit about businesses that I don't know much about and how they work. But at this one, I go, this is way too complicated for me to understand how this stuff's going on in the background. Just continuing, because I know you got to go soon, so I've got to rush through this. Not much to report in terms of governance and leadership. As I said, the president and CEO has been there for 30 years. Not in that role. She's worked in different roles in the business, but lots of stability there.
She started off in the rhythm section. She was the organist and the bass player. Yep.
Backup dancer.
Tambourine.
Yeah. No, nothing in terms of audit problems or transparency issues. Nothing really exciting in corporate activity apart from the fact that they demerged from Prudential 4 years ago. Did announce a big share buyback last year, 2024. They announced $125 million share buyback as part of a $300 million repurchase program. Broker coverage is sort of a consensus of hold. Price targets range from a low of 80 to a high of 108. As I said, it's about 83 at the moment. The average broker price target is around $94.80. So, quite a bit of upside from where it is at the moment. In terms of the risks, fluctuating rates that can impact all of these things that I don't understand, but apparently that's a thing. Regulatory changes, again, which I'm not going to pretend to understand, and market volatility, which I understand. Economic downturns can reduce demand for retirement products and things like that as people aren't really sure what's going on. And, of course, I would add to that, AI and robots are going to eat the world in the next few years, and who the hell knows what that means. But that's true for every business on the planet these days, so I can't score it on that. In terms of the scoring, let me run through the numbers quickly. The average daily trade's about 74 million, so it's pretty big. As you mentioned before, the quality rank from Stockopedia is pretty low. It's a 52. Our quality rank is a bit higher, but Stockopedia's is pretty low, so I couldn't score it on quality rank. We score it if it's over 60 or better. So I didn't get a score for that. The stock rank in Stockopedia is 72. We only score it if it's 90 or better, so it didn't get a score for that either. However, it did get a score for its F score. Its actual F score is 6. We score it if it's 4.5 or better. And that's its financial health score. So getting back to the prop CAF and its ins and outs and all that kind of stuff, it has a pretty good F score, so I was comfortable with that. Now, here's another one for you. IV1, our intrinsic value number one, is $5.26.
Mm-hmm.
The share price is $83. So the current EPS, the earnings per share TTM, is 1.03. So that's why.
$1 or 1 cent?
$1.03.
Okay.
Yeah. So our formula for our first intrinsic value is the current EPS over the hurdle rate, which we have at 19.5%. So our IV1 is quite low when you do it on a $1 earnings per share. Now, the earnings per share normalized for 2025 expected is actually 19.6.
Oh.
When you do the,
That's
if
a
I
huge
do the
rise.
IV1 based, if I do the, well, I think it's because of the way that they state their earnings and it goes up and down, it's all over the place. If you look at that first quarter, it was for the TTM, right? They lost money in the first quarter. If you look at it over the course of the year, it's going to be a lot higher. So if I'd done the IV1 based on the anticipated EPS for the year, would be more like $100, which ties into our IV number two, our second intrinsic value, which uses the future EPS. If I take the 2025 future EPS, it's positive. If I take the 2026 earnings per share, which is actually $21, it comes out at our hurdle rate for IV2 is the cash rate plus 6%, so it's about 10.33%. IV2 comes out at $189. So the price is currently less than our second intrinsic value, and it's less than double our second intrinsic value. So we score it for that as well. So it's it's pretty good. If you look at the full earning in both of those, it would have scored for the first one as well if I looked at the full 2025 EPS, but not at that first quarter. Anyway, moving right along, the book price is $136 equity per share, $136. And again, the price is $83. So I did give it a score for price being less than book. I wrote higher than book here, less than book. And it's obviously less than book plus 30 too. So what else have I got? It does have a 3-point uptrend. It's been in a 3-point uptrend for quite some time. It passed its byline back in late 2023. But it has had a falling share price since late 2025, but it's just gone over its second byline as well. So I didn't score it for a new upturn, but it has just gone above its second byline, so it's broken through that. It seems to be turning around. Growth over PE is greater than 1.5, so I scored it for that. Book value growth is not consistent though, but it's one of these weird ones. If you look at Stockopedia, it's got book value going back to 2019, but it only got spun out from Prudential in 2021. That was its sort of peak year for its book value at around $10.5 billion. It's gone down to 9.7 now. It's gone up and down over the last 4 or 5 years since it got floated out. Couldn't score for that. PE is not less than the yield. The yield's 3.47. PE is 4.13. The yield is not greater than the bank rate, which I've got at 6.9 in the US. But as I said before, I did score it for PropCAF being less than 7 because the PropCAF is 1. Anyway, number of items I could score it on was 14. It got a score of 11. Quality score from our perspective was a 79%. but understanding that the prop CAF is maybe applicable, maybe not, I went with it anyway. Versus the Stockopedia quality rank of 52. Ended up with a QAV score of 0.79 at the end of the day. So
that's high. Yep.
It is
Driven
high,
by low prop
although
CAF.
not for our US. Well, a lot of our US buy list stocks have quite high QAV scores compared to Australian QAV scores. And probably because a lot of them are kind of weird prop CAFs too, I think. A lot of the financial services companies that end up on our buy list. But I've done very well. Again, Willis Lease Finance Company, what you're talking about, Willis, it goes with the Jacksons. I mean, it's still up 200% since I bought it.
Yeah, right.
A year or two ago, 18 months ago. So I don't know what its prop CAF was at the time. I can't remember, but it was probably a weird one at the time as well.
Yeah,
anyway,
but like the P,
that's...
the company is still 4 times earnings. So even if the prop CAF is lumpy or based on some, write-ups and write-downs, and the PE will have that same issue, but 4 is still very low for a PE.
Yeah, very low PE. And, there's other metrics. Like its F score is good, but it's like the IVs are good. Its price is less than the book. So it stacks up well on the value side of things. Quality side of things, maybe not as great as we would want sometimes, but it's a balancing act for us usually, right? Combination of quality and a combination of value, which is why it's QAV.
Yep. And momentum.
That is
sentiment.
JXN. Do your own research. Complain on YouTube if you think it's got too much debt or something or whatever, but scores well on our buy list.
Or if you're
we don't own it. Because
if you're an insurance specialist or an insurance analyst, come on the show and tell us about prop CAF for an insurer so we can learn.
Please do. All right. Well, that's QAV America for this week, Tony.
Thank you, Cam. Happy investing, everyone.
NYSE.
Yes,
Happy NYSE, everyone.
Happy NYSE, yeah.
Happy MAGA 7. Come, if you're living in LA, stay safe.
Yeah, please.
I was telling Tony in our last show, my son who lives in LA these days is back in Brisbane at the moment, and I'm trying to convince him not to go back. He's supposed to go back to LA at the end of this week, and I'm trying to convince him not to do that until we know which way the wind is blowing in LA. I don't like the looks of things there at the moment, but if you are in LA, please stay safe and stay calm.
Yeah. Yeah. Thanks, Cam. Talk to you next week.
Thanks, Tony.